Thank you, Madam Chairman. And Dr. Goodspeed, being an old ag-econ guy from Oklahoma State, I was very pleased to hear you discuss the unique concept of the inelasticity of demand, because that's really difficult for a lot of people to get a grip on. The concept that you either have enough or you have too much, and that price dramatically shifts from one perspective to the other. But back to the core issue. The Fed's balance sheet sets at just under $9 trillion, more than double the pre-pandemic amount. The total U.S. public debt's increased nearly $7 trillion since late in January of 2020. Dr. Goodspeed, can you discuss how this drives inflation and overstimulates the economy from a macroeconomic perspective?
Certainly. Thank you, Congressman Lucas. So what we've observed in the past year is an almost unprecedented excess of demand over supply in the U.S. economy, and that has to a large extent been accommodated by the Federal Reserve. And if we look at a broad measure of the money supply in the United States, that has increased by about 40% since the start of the pandemic.
So as we would say in my town meetings, if you dramatically increase the amount of money chasing the same or fewer goods and services, then you drive up the price of the goods and services, correct?
That is correct.
Thank you, Doc. Farmers across the country are experiencing higher costs for chemicals, seeds, fertilizer, equipment, fuel, labor, among other increased input costs. The squeeze and uncertainty felt by farmers and ranchers right now will be felt for years to come. This means higher food prices we see now may be with us for some time. Dr. Goodspeed, can you discuss how persistent inflation isn't simply a supply chain, logistics, or a pandemic recovery issue, but spreads much deeper into the economy?
That's right. Sometimes we see relative price increases where prices are increasing in one sector or another, but what we've seen in the past year is broad-based inflation that crosses multiple sectors, and it hurts working people very hard because they don't have the same bargaining power that other workers have. Things like rent, food, energy, utilities are much bigger shares of their disposable personal income, and many lower income households don't have hedges against inflation, the principal of which is housing.
So the little guys, we would say in town meetings, don't have flexibility. They're locked into their situation on their income with their expenses ever increasing. This month, the national debt topped $30 trillion, and the Congressional Budget Office predicts that the debt to GDP ratio, I should say, will double over the next 30 years. Doctor, how troubling is this for the long-term, and I mean long-term, health of the U.S. economy?
Well, yes. In the short term, it means that every 25 basis point increase in interest rates is going to raise the cost of servicing that debt by $75 billion. In the long term, look, if we look over history when the U.S. has had debt to GDP ratios of this level, the way we got out of it is not especially encouraging. Some of it was from growth, but we do not have those growth tailwinds that we had in the aftermath of 1945. A lot of the rest of it was inflation and what we call financial repression, which was basically capital controls and implicit pressure on banks to hold federal government debt. Those are not good recipes.
I started out farming, Doctor, in 1977 as we slid into the inflationary period of the Carter years, and we went through Mr. Volcker's dramatic tightening of the money supply, and we saw the old 1930s interest rate caps come off. I borrowed cow feed money at 17% in 1981 and was so happy to get it, so happy to get it. But I also watched a generation of young farmers and ranchers who'd come home from the Vietnam War, who were absolutely exposed economically, be destroyed. And the last of those sheriff sales were still taking place in the 1980s. So I carry a few scars of watching my neighbors. We need to try to avoid that, don't we, Doctor?
I think that's right. And when one looks at past episodes of the Federal Reserve having to play catch up with inflation, they have to respond even more aggressively than had they responded earlier in order to wring that inflationary pressure out of all sectors. And that was what we saw in the early 1980s.
The longer the binge, the harder the hangover?
Yes.
Yield back.